Okay, let's get into it. We are doing a deep dive on Acuity Brands, that's ticker AYI, specifically their fiscal Q1 2026 earnings call, which dropped pre-market on January 8th. And we really need to unpack this one because the market's reaction was, well, it was something else. They posted what looked like a really strong quarter, good execution, and the stock just crashed.
That's the whole puzzle right there. It's the core tension we really have to figure out. I mean, Acuity has been on this multi-year journey,
Yeah.
trying to pivot from just being a cyclical lighting company to this high-growth, intelligent spaces tech platform.
Right, and the stock price reflected that ambition. It was trading in the high 300s.
Exactly. The market priced it for absolute perfection. It was expecting a growth stock story, and what they got this quarter was perfect execution from the old cyclical company. But there was no raise, no glowing forward guidance that the new expensive tech stock needed. Our job is to trace the why behind that huge disappointment. I think that's it. Management delivered on their promises for operational discipline, but the whole narrative it hit a wall of incredibly high expectations. They did their job, but the market saw a slowdown coming, and it reacted violently.
So let's start with the snapshot of the results, because the disconnect between the numbers they posted and that market reaction it's genuinely jarring.
Yeah, lay out the headline profit numbers for us.
Okay, so adjusted earnings per share, they reported $4.69. That beat the street consensus, which was sitting at $4.59. So a solid beat, about 2.2%.
Okay, that's a good start.
Revenue came in at $1.14 billion, which was basically right on the money with estimates. That's about 20% growth year over year, but a lot of that was helped by the QSC acquisition.
And what about EBITDA? That's always a key one.
Crucially, adjusted EBITDA was $211.2 million. That translates to an 18.5% margin, which is excellent. It was well ahead of the street's estimate of about $198 million. So let me get this straight. A clear beat on EPS, a beat on EBITDA, revenue right in line. By any traditional measure, that's a great quarter, but then there's what the stock did.
And this is the critical part. Despite all those beats, the market sentiment was just toxic. The stock closed the day down $49.84. That's a drop of 13.48%. Massive.
And that number, that 13.48%, is so important because it tells you just how deep the disappointment ran.
We can actually quantify the shock. The options market, it had an implied move of about 8.47% for the earnings. The actual drop blew past that by 5 full percentage points. That tells you this wasn't just some noise. This was real institutional conviction that the forward-looking story was broken, regardless of what the past quarter looked like.
It was a guidance story, not a history lesson. Okay, so if the profitability was so strong, where did it come from? And why didn't the market care? Let's dig into the financials. We need to find the cracks.
Well, the profit story was really about efficiency and cost control. It wasn't about booming demand. The company's total operating margin was basically flat year over year, around 14%.
And management was hammering that message home, right? The operational discipline.
Oh, absolutely. Their core message was operational discipline and margin expansion. They're targeting long-term about 50 to 100 basis points of operating profit margin improvement per year, which is great. It's disciplined, it's steady, but maybe too slow for a stock with that kind of multiple.
I saw a potential red flag in the cash flow numbers. They said free cash flow margin was around 10%, but that was actually down from 11.9% last year. If they're executing so well on margin, why is their cash conversion getting worse?
That is a fantastic point, a really, really sharp observation. For a company that's supposed to be pivoting to high-value software-like revenue, you expect stellar cash flow conversion. The fact that FCF margin went down suggests, well, either working capital is a problem or the profit from those accelerated orders, we'll get to that, didn't actually turn into hard cash yet. That's a nuance the market definitely picked up on.
Okay, let's break down the two main segments. Let's start with the old business, Acuity Brands Lighting, or ABL.
Right, ABL really highlights the problem. The overall market is still tepid. Sales were $895 million, which is up only 1% from last year. The market's just waiting for some clarity on interest rates, on policy.
But their margins were still good, right?
The good news is yes. ABL's adjusted operating profit margin actually expanded by 60 basis points to 17.9%. But, and this is key, that was mostly driven by lowering operating expenses, the OPEX.
Yeah, management was very explicit about that. The CFO said they'd already taken costs out in previous quarters. So that margin beat wasn't from a surge in demand. It was internal belt tightening. That's a huge difference.
It's a critical distinction. Now, let's contrast that with the growth engine, the future. Acuity Intelligence Space's AIS, sales there were $257 million. And that got a huge boost from the QSC acquisition. But even organically, Atrius and Distance, they grew in the mid-teens, and QSC did too. And here, the adjusted operating profit margin expanded 100 basis points to 22%. So strong growth and better margins.
Okay, so if AIS is doing that well, it should be the hero of the story. What's the core idea there? What are they selling that justifies that high valuation?
This is the part of the story that really holds the long-term potential. They're moving toward what they call autonomous spaces. So think way beyond just a smart light switch.
Okay, give me an analogy. What does that actually look like for a customer in their building?
Sure. Imagine a big office building. They're integrating devices like the Distance Move. It's this multi-sensor thing that detects heat, light, sound, air quality, and it uses AI to process that data right there on the device at the edge.
Okay.
Then that data feeds into their main control platform, which handles screens, cameras, microphones, and the system can then automatically change the lighting, adjust the temperature, even lower the shades based on who's in the room and what the air quality is like. No one has to touch anything. The value is huge energy savings and a better experience for the people in the building.
So they're not just selling light fixtures, they're selling operational efficiency as a service, as a platform.
Exactly. And the QSC acquisition is a huge piece of that puzzle. QSC itself is growing like crazy, something like 40% sales growth. And we saw really compelling examples of them cross-selling this stuff, like in the refuel segment.
Right. The refuel example was interesting because it tied the old business and the new business together.
It did. They started by selling traditional outdoor canopy lighting, from ABL to these gas station convenience stores. But now they're adding AIS products like sensors to monitor the refrigeration units in the back. They're attacking the whole vertical with a complete solution.
And management was pretty clear they aren't just shoving this tech down customers' throats.
Correct. They really emphasize that they want the customer pulling the solution through. The idea is that it creates a stickier, more durable relationship when the customer sees the value themselves.
So let's recap. We've got great execution, we have margin expansion from cutting costs, we have innovative tech and AIs that's growing fast, and they're paying down debt. If all of that was so perfect, where did the story fall apart so badly that the stock crashes 13%?
This is it. This is the pivot point. The entire crash comes down to two words: backlog normalization.
Backlog normalization.
The CFO was explicit about it. Both ABL and AIS got a big artificial boost in the last couple of quarters. Customers were placing orders early to get ahead of price increases, so they had this huge elevated backlog.
So that backlog was a temporary tailwind. It wasn't durable, and it was masking weakness in current demand.
Precisely. And now that backlog is gone. It's normalizing. So the CFO came out and warned that historical seasonality is going to be all skewed. And he said Q2 sales could be down more than normal sequentially. That's a huge warning of revenue deceleration. And the market heard that and treated it like a classic cyclical stock warning and just punished it.
So let's put that in context. Pre-call, the stock is trading near its highs, right? That sets this incredible beat and raise bar, which they couldn't clear because they explicitly warned about Q2 getting weaker.
Yeah, that's fair. They were so focused on executing their plan, the margin expansion, the cost control, they delivered on that. But they maybe failed to recognize that the high stock price demanded a growth acceleration story, not a warning of a sequential decline. The lighting market is still tepid, and they're relying on internal execution, not a big macro tailwind.
Okay, let's touch on the Q&A. The tariff discussion, that seemed to raise another question mark about the future.
Yeah, the Supreme Court ruling was coming up. Management's view is basically that things will mostly stay the same. They think even if the court strikes down the tariffs, the administration would just find another way to do it. But the interesting part was about the channel. If the tariffs just disappeared, well, Acuity sells to a distributor, who sells to a contractor, who sells to the building owner. It's not like Acuity could just pocket that difference as pure profit. The whole market would just reset.
So any tariff relief isn't some magic bullet for their margins. It just changes the competitive game, which they think they're well positioned for anyway. It seems like it was the combination of that Q2 warning with no immediate macro catalyst that the market just couldn't handle.
That's the whole story. Their execution is credible. The management team is doing what they said they would do. But that 13% drop says the market is done giving them credit for good execution. It wants to see great upside on the top line, and they just promised the opposite for Q2.
Right. Before we move on, just think about that for a second. If you're a PM holding this thing at $370, That's a genuine gut punch, a single day drop like that. The market is basically saying, we don't believe the tech growth story is coming fast enough to save you from the cyclical lighting business.
It's a fundamental retracing of the company, which that brings us to the most interesting and purely speculative part of our deep dive. We look at the data, we look at the reaction, and we consider an out-of-consensus trade idea. And we have to be crystal clear here. This is not financial advice.
Definitely not. We are just spitballing here, pitching an idea to the committee. So the market already hit the stock with the 13.5% penalty. The stock is down 14% in a month while the S&P is up. The setup is clearly bearish.
It is. So here's the trade idea. Short AYI, targeting the $300 range.
Wow. Targeting $300, that's roughly where the stock was before the QSC acquisition really started paying off in 2024. That is bold. Walk me through the logic. Why short a company right after they beat on earnings?
The logic is all about the CFO's warning and where that Q1 beat came from. It wasn't from real demand. It was from those two non-durable things, customers pulling orders forward and deep OpEx cuts. The CFO practically screamed that Q2 is going to face headwinds from that backlog normalizing. It could be more down than normal.
So you're betting that the Q2 slowdown is going to be even worse than people think, and it will confirm the market's feel that demand is really falling off a cliff.
Correct. The market is now looking at this like a cyclical, capital-intensive business again. And remember your point about free cash flow. It was down year over year. They're not converting that platform story into cash. So given the high volatility, the trading volume was almost double the normal level. You could use a leverage short, maybe deep in the money puts. You're capitalizing on that deceleration signal for Q2, betting the market keeps punishing good execution until it sees real growth. That huge miss on implied volatility suggests the big institutions are selling, and you're just riding that wave down to a more reasonable valuation around $300.
That is a sharp, if bearish, analysis of a really tough quarter to read. Okay, let's do a quick recap of our deep dive on Acuity Brands FQ1. They delivered on execution, EPS beat, margin expansion, paid down debt, but the whole story just crashed into that wall of elevated expectations and the warning about backlog normalization. That's what triggered the sell-off. The market basically decided Acuity is still a cyclical stock for now, not a tech stock.
And the final provocative thought for you to take away is this. The stock is now a major underperformer. So does management's focus on slow, steady margin improvement, that 50 to 100 basis points a year? Does that justify the stock recovering that high multiple it had? Or is this new lower price the correct price for a company that's just executing well in a really tepid environment? What's the right price for perfect execution when revenue's about to slow down?
The jury is out. We'd encourage you to keep watching the key catalysts, the growth in intelligent spaces next quarter, whether they can sustain those margins, and most importantly, if that free cash flow conversion gets better. Until next time, keep digging into those transcripts.